Okay, I think we are ready and we can start. So, good afternoon, everyone. Welcome to the May 2024 session of the AASB Dialogue Series. This is a joint event with the CPA Australia and also the CAANZ. I'm Eric Lee from the AASB office, and I'll be moderating the session today. Today's topic is financial reporting on climate-related commitments. We'll have two insightful presentations followed by a panel discussion. Feel free to submit your questions throughout the session using the Q&A function. We'll try to answer questions if possible. Before we begin, a few housekeeping reminder. The views expressed today are those of the presenters and do not necessarily reflect the views of our affiliated organizations. Also, this session is designed to encourage open discussion on climate-related financial reporting topics. It does not endorse specific views or provide accounting or reporting advice. If you have any specific questions about accounting or reporting requirements, please seek professional advice. Now, many of you are also eager to find out more updates on the AASB ED SR1 Australian Sustainability Reporting Standards. We can't offer much update about it, but what I can inform you with confidence is that the AASB staff are currently analysing the feedback received for the board's deliberation. Now, with that said, let's dive into the session. I'll start by providing some background information, and then I'll hand things over to our presenters for their insights. So next slide is a slide about why are we discussing this topic. Now, we are aware that entities are increasingly making statements about their commitments to addressing climate change, for example, net zero commitments. It is very unclear, though, what those statements really mean. If you look at the disclosures in detail, some entities use some strong wording such as we will or we are committed, and some entities use perhaps softer terms like we plan to or we are aspired to. Now, given these disclosures, a common key question is that if an entity claims that they are committed to net zero commitments, shouldn't that be reflected in the financial statements? If not, why not? Is that because those are just greenwashing claims? And so there is some confusion and an expectation gap in the market, which is important for further clarity. Next slide. It's a quick update. Just last week, the AASB finalized an agenda decision discussed by the IFRS Interpretation Committee regarding climate-related commitments. Now, I would encourage everyone to read the updates and the decision made. It's important to understand, though, the IFRS Interpretation Committee's role is to interpret the existing accounting standards. That is the wording in the current standards. It is not about how they wish the standard was written. So what is the committee's conclusion? By looking at a fact pattern about public statements on climate-related commitments, the committee concluded that the existing accounting standards provide adequate guidance and principles for the accounting of provisions under the accounting standards IAS 37. Now in Australia, it's AASB 137. Next slide, I'm going to give some quick observation from the decision. Now, firstly, it is a reminder that accounting standards IAS 37 or AASB 137 has already included the concepts and the accounting guidance for constructive obligations. Now, effectively, a public statement related to committing to something would possibly give rise to constructive obligations. However, that's not always the case. Like any principal accounting standards, it depends on the facts of the commitments and the circumstances. So judgments are needed at each reporting date. And then even if it is concluded that there is a constructive obligation, it is not always the case to recognize a provision on the balance sheets. Entities must also assess the recognition criteria of provision, for example, whether and when there is a trigger event that creates a present obligation. Again, judgment is crucial. So in summary, it is not necessarily that liability should always be recognized on the balance sheet when entities make public statements about commitments to do something. Judgment is needed based on facts and circumstances. Now, some users of financial statements may be wondering if an entity has committed to something and they're not required to reflect those commitments in the financial statements, how then users can get related information for better decision making. So if we go to the next slide, this is where connectivity of information comes into play. In the last dialogue series, we talked about the boundaries and connectivity of reporting. And remember, there's also this overarching concept of materiality that entities need to consider. That is, although there is no impact on the balance sheets, if information is material to users, then entities should consider disclosing those information. Now, whether this information should be disclosed in the notes to the financial statements or outside of the financial statements is something that I think the practice will evolve. There's always a debate on where's the best location to provide those information. Today, we will touch on the broader question, what are the considerations or challenges entities have in terms of providing information about their climate-related commitments? The IFRS Interpretation Committee looked at fact patterns in a scenario where entities are committed to change their operating activities to reduce or offset greenhouse gas emissions. But this session will also discuss the possible scenarios where an entity is committed to changing its operation if or when they are affected by the climate or other related factors, such as flood or soil erosion for farmers. Again, I need to reiterate that we do not endorse specific views or provide accounting and reporting advice in this session. Please seek professional advice on this matter as judgments is needed for facts and circumstances. So next slides. With this introduction, we'll now like to introduce our presenters. Perhaps I would say almost about 10 years ago, and Sue can correct me on this, the AASB was contacted by a number of researchers who are passionate about this topic. I'm going now to introduce them, Dr. Claire Horner, Senior Research Scientist from CSIRO, and Dr. Sue Igilvy from Farming for the Future program will provide a presentation and their perspectives related to this topic in the context of biodiversity, which is also a very timely, relevant topic that's been discussed in the market these days. Next slide, we will then have another brief presentation from Lachlan, who is the Managing Director from AI Algorithm, to share with us some insights about how AI and technology can play a part in understanding the measurement of greenhouse gas emissions. And I think this presentation can provide examples on how entities can get data about how the climate may affect their operations and therefore considering the disclosures in accounting and reporting. We will then have our esteemed panel members to provide their insights. We have Alison, who is the Head of Impact and Ethics of the Australian Ethical Investments, who is the users perspective, will provide us some users perspective. Karen, who is the Business Reform Leader of CAANZ, and Patrick, who is the Sustainability Leader of the CPA Australia, to share their perspectives. And with that, I'm now going to hand this presentation to Dr. Claire Horner and Dr. Sue Igilvy for your presentations. So can I please request Claire to share your slides so that we can then follow your presentation. Thanks. And while Claire is putting the slides on the screen, please a reminder for the audience, please feel free to submit your questions through the Q&A function. We'll try to answer those questions if possible.
Sorry, I'm having some, I would say, technical issues, but they appear to be user issues.
There you go.
Okay. Lovely. All right. Thank you so much, Eric.
just Claire, for a sec, if you could hit display settings and change your presenter. Yep, swap that one. Yep. Thank
okay.
you.
Great, thanks, Sue. And thank you, Eric, for the introduction and for the opportunity to speak to you all today. So we're really excited to be presenting our research. This was a project that we did in collaboration with the University of Tasmania back in 2021, I think it was, Sue, and this was part of their corporate internship program. So I'd also like to take a moment to acknowledge our fabulous interns, Hamadri and Maria, who really should be credited for a lot of this work, and they've both gone on to do wonderful things in the carbon accounting space. So a shout out to them. So we were looking at this issue around public commitments and the potential implications of making those commitments. As I said, back in 2021, we were looking at it in the context of biodiversity and commitments of no net loss of biodiversity. And this paper is published on the AASB working paper series, so you can download it from the AASB website if you like. I should also acknowledge the traditional owners of the land from which I speak to you today. That's the Muanina people, and the current custodians of the land is the Palawa people, and pay my respect to elders past and present. So what we did with this paper is we tried to come up with a very simple but realistic scenario of what, in order to work through what the implications of public commitments to no net loss, whether that be no net loss of biodiversity or no net loss of carbon. I think the logic applies regardless of the type of commitment. Now, because of our interests, we focused on biodiversity. So what we have here in our scenario is 3 key parties. We have Clothing by You, so they are a clothing manufacturer, and their main supplier, or their number 1 supplier, is Woolly Jumbuck. So Woolly Jumbuck have a sheep farm, and they provide 50% of their stock to Clothing by You and 50% to other clients. Clothing by You, because they are a environmentally conscious provider, have made a declaration a public declaration that they have a policy that they will have no net loss of biodiversity across their entire supply chain. And this, I think, is also where it might be particularly interesting for people out there, because as we know, with the upcoming the S1 and S2 standards, they are looking at commitments and impacts across the entire value chain. So Clothing by You have made this commitment. It's also really important to emphasise that Woolly Jumbuck, their supplier, they are not a party to this commitment. And so they have no obligation to manage biodiversity in their operations. This commitment is made by Clothing by You. So what has happened is Woolly Jumbuck they're looking at the market, and they can see that there's expected increase in demand for their product. So they have cleared some remnant native forest to convert that to pasture so that they can increase their grazing capacity. So that has resulted in a loss of biodiversity. Though that, whilst they are operating within the law and they're operating responsibly within the bounds of their own operations, that has implications for Clothing by You, because they now have a loss of biodiversity in their supply chain. So the question then is, does this give rise to an obligation to disclose in their financial accounts. So we looked at the existing, much in the same way as the AASB did in their decision note. We looked at the existing accounting standards and said, okay, so what do they tell us about the potential disclosure implications? So we need to consider the purpose of financial accounting, which is, of course, to provide information that is useful for resource allocation decisions. And we looked at the standards, AASB 137, and looked at the issues around what they say about constructive obligations. And we also considered materiality in this as well. I won't dwell on this too much because this is all, but we basically went through the same steps that the AASB did in their decision note. And so it was actually really gratifying for us to see when that came out that they had drawn much the same conclusions that we did, that due to their public commitment of a formal policy to have no net loss in their supply chain, once they have recognised that there is a loss, they then have an obligation to recover that loss. So they have an obligation resulting from their past events, and Sue, in a moment, will demonstrate that we can provide a reliable estimate of the amount of the obligation to recover those, to recover that loss. So does that result in an obligation? So we say yes in this particular case, because they haven't made that public declaration. There is now an event which has caused a loss of biodiversity, which they have an obligation to recover and disclose. And the disclosure is important here because I think the issue of materiality is probably something that's going to come up in the discussion. So we looked at what is materiality, and it's very much entity specific, and it's not necessarily based on magnitude. It could be based on the nature of the obligation as well. And so looking at broader contextual factors as well, and this was something that the AASB alluded to in their decision as well, is that it's not just the public declaration. There might be other contextual factors that also would give rise to a public expectation that the party recover or absolve this obligation. And so our approach was that due to their public declaration, their formal policy, and the other contextual factors around their activities, that there is an obligation to disclose in the balance sheet that it is material, that any biodiversity loss in this case is material. So now I will hand over to Sue, Sue Ogilvie, and she will talk more about why and how we were able to make these disclosures.
Thank you, Claire. So we prepared some very simple accounts to provide the basic fact pattern for the realisation that there had been a net loss of biodiversity event. So we prepared a set of tables, ecosystem accounting tables, that are coherent with the United Nations System of Environmental Economic Accounting, which, as most of you would recognise, as the global standard that's emerging to help us to include ecosystems or natural capital in our accounts. So the very simple scenario here is prepared by saying that Woolly Jumbuck, the table on the left where we've got asset accounts, have in 2015 300 hectares of grassy woodlands and 700 hectares of pastures for a total of 1,000 hectares. The change that Woolly Jumbuck have made to their property is to convert 150 hectares of grassy woodlands to 150 hectares of pasture, resulting in that net change to the type of ecosystems on the farm, the type of natural capital, without changing the farm size. To support the thought experiment, which was the underpinning of this financial accounting, we used a very simple approach to quantification of biodiversity for this case, nominating that the grassy woodlands were representing the presence of all of the biodiversity that you could be expected for that ecosystems, whereas pastures were accounting for only 0.2. I'd like to sort of say as a slight aside here that the actual quantification of biodiversity is not a simple thing. And so the numbers here just reflect numbers which were useful to us in conducting this thought experiment. So anyone who's joined this call thinking that we're revealing the answer to the Holy Grail, which is how do you cost effectively account and measure biodiversity, sorry to disappoint you. These are numbers really to have the thought experiment about the financial accounting treatment. So the table on the right is clothing by use accounts, effectively, that give them the quantification for biodiversity, that gives them the fact that helps them to detect the net loss of biodiversity. So in 2015, the biodiversity that they have associated with their engagement with woolly jumbuck is 220. So people on their calculators can see that we've got that from multiplying 300 hectares by 1 and 700 hectares by 0.2, and then dividing by 0.2 to reflect that Clothing by You only purchases 50% of woolly jumbuck's assets. So I know I'm talking to accountants, you're probably way ahead of me on there. And then in 2021, when Clothing by You receives its updated ecosystem asset accounts from woolly jumbuck, it realises now that due to that change from grassy woodlands to pasture, that we've got a loss of a reduction in biodiversity. And that's the amount of biodiversity that we have in the obligation row there, which is quantifying the loss of biodiversity. If you could move to the next slide for me, Claire. So what Clothing by You decides to do as a result of this net loss of biodiversity is it forms an agreement with another company called Echidnas Incorporated, and it pays Echidnas Incorporated to convert 100 hectares of its pastures to 100 hectares of grassy woodlands. So Echidnas Incorporated starts the year in 2021 with 500 hectares of grassy woodlands, 200 hectares of pastures. And then as a result of the investment by Clothing by You, it starts to change 100 hectares of pastures into 100 hectares of grassy woodlands to, over time, restore the biodiversity. Now that, if you notice on the table ahead, on the tabletop, we've estimated that that could take 80 years. So the table on the right then reflects the accounts for Clothing by You as it restores its obligation in biophysical terms. So 2021, we've got the biodiversity that it is in its supply chain, along with its obligation to restore some biodiversity, and that has been nominally incremented by a small amount. So that's the demonstration of the pattern of facts that are needed to establish the emergence of the recognition of the net loss of biodiversity and to account for the quantity of the obligation. And so I'm going to hand back to Claire, who's going to explain in simple terms how the dollar amounts for that will appear in the financial statements. Thanks, Claire.
Thanks so much, Sue. So just very, very briefly, because we're all accountants here, so you will understand that we recognise our initial obligation of that 200,000 as a provisional an obligation in the balance sheet, and then over the course of the 80 years, as that we could see the restoration occurring and those payments are made, then that obligation will be reduced. And I'd probably just also emphasise that the disclosure by Clothing by You is only possible because of the accounting that is being conducted by their supplier. So the fact that they are able to obtain that information to be able to recognise their obligations. So I think that that's something that we're all probably interested in going forward, is the implications of implications of accounting for suppliers, as well as for the people who are making these public commitments. So that's all from us, I think.
Thanks, Sue and Claire. So perhaps before I hand it to Lachlan to put your slides up for your presentation. Sorry, Claire, do you mind? Yeah, thank you. And then Lachlan, you can now put your slides up. While you're doing that, I'm going to actually ask Sue and Claire a question, because in Sue's presentation, Sue, you mentioned that the biodiversity is hard to measure, and I realize that many of us in the audience, we are accountants, we're not scientists. Can you give us a bit of insights of what are the challenges of measuring biodiversity?
Yeah, very happy to. And this, because this is a very, very important question. And I actually think that one of the well, I'm hopeful that for the opportunity for biodiversity scientists to work with accountants might actually reveal tractable ways to overcome it. So without making it sound impossible and have everyone throw their hands up in despair and say it's too hard, the sort of difficulties that I see are along the lines of, what do we mean by biodiversity? It's a very complex, mostly scientific topic at the moment. And so when we're talking to each other about an amount of biodiversity, it's really important that we are actually understanding the same topic. Biodiversity experts will tell you that sometimes they're talking about species richness, you know, the number of different species or species abundance, or they could be talking about the composition of an ecosystem and its reflection of nativity. So because this has come from the scientific world, there's a lot of nuance which might be useful in tackling this concept, but it might also obfuscate things. So that's the first thing, is definition, making sure that we knowing what we're talking about. And from my point of view, I'm a big fan of the accounting standards approach to the qualitative characteristics of useful information, because I think what that has is a tremendous pathway forward for us to resolve some of those conceptual difficulties. And then secondly, the second part of difficulty of biodiversity measurement is, and Lockie's probably going to talk to this in terms of the ability for remote sensing to actively and accurately measure biodiversity. It's not there yet, and it's incredibly expensive to send botanists out to look at species. So we've got a conceptual challenge and a technical measurement challenge to overcome. And then if that's not sounding hard enough, and I really don't want people to throw their hands up in despair and say it's too hard, because I think if we can be thinking we can land people on Mars, then we can think we can probably solve this problem. But the last thing I would like to recognise is that in that little simplified scenario that we just presented, where we blithely said we'll get echidnas incorporated to convert some of their pastures to grassy woodlands, it has to be recognised that actually the prospect of returning a fully expressive native grassy woodland out of a pasture at any point in the future may well be impossible. It's probably biophysically impossible, and notwithstanding the effect of climate change on all of this. And so we're going to need to be able to account for the fact that in restoring an obligation to, or a commitment to biodiversity, we actually will have to actually address the question of, if it has been converted, how much is enough to satisfy that obligation? So I hope I haven't overwhelmed everybody with exploring the technical questions. I'm sure we can make a tractable answer from them, but there is a little bit to go. Sorry, Eric, if I've taken too long to answer.
No, thanks. So that's amazing.
Can
I think you go, Claire.
Sorry, can I just add just one more
Yeah.
thing to that? So because as Sue said, it's, you know, biodiversity is such a complex sort of concept. So what we are doing at CSIRO as me as an accountant working with scientists on trying to, you know, solve these problems, we're looking at proxies for biodiversity. So and so we look at, you know, condition hectares, or some people call it habitat hectares. So rather than looking at biodiversity itself, you look at the capacity for the environment to support biodiversity, and that can be measured. I wouldn't say easily because I'm not doing the measuring, but it can be done.
No, thanks, Claire. That ties to Lachlan's presentation about, you know, how can entities measure with using technology and AI. So, Lachlan, I'm going to hand the presentation over to you.
Okay, great. Thanks, Eric. And yeah, good work, Claire and Sue. So yeah, largely for, say, a supplier or a bank or anyone to try and work out the emissions of, you know, your business, there's two main approaches. So one is you ask all the suppliers how many trees you have, how many hectares, how many cows, etc. And then you try and use that as a proxy to work out emissions and biodiversity. The other, and there's sort of challenges with it because, you know, is the data you're getting correct? Is there greenwashing involved, etc.? The other approach is using satellite measurements, and there's a range of different satellite tools that are measuring different emissions and biomass in different ways. So I'll just go into that in a bit more detail. So yeah, with the emissions calculations, so even from if you apply 1 kilogram of fertilizer, the emissions can be 200% greater in one paddock compared to another paddock. And that's just the way the whole soil ecology, the soil moisture, etc., work. So it's quite difficult just to even ask how many kilograms of fertilizer have been applied to work out, you know, across your supply chain. So the other approach is NASA's developed a carbon sequestration or net carbon sequestration approach, and that's measuring the grams per square meter that's being sequated or the net effect and being emitted. So that's passing Earth every 90 minutes, and that's measuring at 9 kilometer gridded measurement in terms of what's actually happening, and it goes all the way back to year 2015. So you get quite an accurate measure of what's actually happening across the Earth. And NASA's done this by leveraging flux sites. So they use about 1,000 flux sites throughout the world to calibrate the models. So it's been in development for about 7 years now. So this is one of the models that we've been using to help understand the emissions, the sequestration rates and biomass across Australia. And we do that down to the land parcel level. So for methane, for example, there's actually satellites that, it's not measuring the methane like a sniffer, it's looking at the way light particles are being absorbed by the different data, by the different gases in the atmosphere. So you can see on the left here is a very unique signature. So the satellite measurement across 3 different methane plumes have all come through almost identical pattern. So you're able to tell at 60 meter resolution the amount of parts per million of methane above the specific areas. So I've had a look across, you know, it's coming up as quarries, landfills, gas plants, etc., where the high methane is being emitted. So the model's been ground tested at plus or minus about 20%. The larger satellites at a higher grid, you know, it's around 95% R squared. So it's, yeah, incredibly accurate. And similarly with biomass, so probably the most state of the art is a LiDAR that's attached to the International Space Station. So that's passing through, and it's actually sending down a laser beam above the biomass, and that's picking up from the canopy height is the first reflection, down to the last bounce, which is the Earth. So it's measuring the height of the trees and also the effectively a 3D model of Australia or the world. And that's every 25 meters by 25 meters, but that's enough to accurately understand biomass in terms of actually tons per hectare. So again, yeah, we try and join it all down to land parcels, because then if you know where your suppliers' land parcels are, it becomes a simpler approach to understand the emissions. So yeah, this is a sample of all the different variables that we use. And then we downscale it. So some of the samples from measuring methane might be at a higher granularity, like the 9 kilometre gridded. So we work out the features that NASA's models and the science is providing. So that's vegetation growth rates, for example, soil moisture, the actual emissions, a lot of the factors that are driving it. So we can downscale it depending on how the land parcel itself is, like if it's greater or smaller than that 9 kilometre gridded approach. So it's using machine learning algorithms that are picking up on the patterns over all the time, and the say fertilizer emissions are much higher when soil moisture is high, for example. So the model's understanding that and learning all the time. And yeah, that's about it. I'll pass back to Eric.
Thanks, Lachlan. So that's amazing to me, because I didn't aware that these days technology can do so much on measurements. But I'm sure we all are learning and we're on the journey together. So now come to our discussion with the panel. As I mentioned before, we have Alison, Patrick, Karen be on the panel, and we also have Sue, Lachlan, and Claire who presented on the panel as well. So we'll be happy to discuss any questions that you have in the Q&A, and we also have some discussions about certain topics. So the first question I'd like to pose it to Karen and then Patrick. So what are the general feedback for Karen, CAA, and ZET heard from members about the challenges of providing financial or non-financial information about climate-related commitments?
Thanks, Eric. And I guess, look, it's as I think has been explained so far, it is a challenging area, and I think that there's a lot of judgment that's going to be involved in this, and there's probably limited examples out there, which is often where accountants go to go, okay, what's happened here? What can I, what's mine most connected to? Can I leverage that? So I think we feel like we're a little bit at the leading edge here around actually practice in this space, and I think that makes it quite challenging. Some of the areas, I guess, of challenge that we've seen are really around actually understanding the commitment and exactly what does that mean. Is it, if I'm going to say I'm going to be net zero by 2030 or 2050, does that mean from that point onwards? Does it mean at that exact date? Does it mean something that I need to have built up to that in the period before then on a trajectory? At what point does, how do I actually unpack that commitment? And then that lends itself to then, when does that past event trigger? And therefore, in terms of recognizing the constructive obligation. And so we have had some conversations around exactly where does this commitment sort of sit, and therefore, when do you get that past event based on that? And one of the other challenges that came up recently in the discussion is obviously there's also a lag effect on actually measuring emissions. So that creates its own challenge, because as at 30 June 2030, I'm not going to know my emissions to 30 June 2030. That's going to take me a little bit of time beyond that. So working out that, and I guess the other thing I'd sort of put into this as well is obviously the challenges around understanding the commitment, and therefore that past event of this financial statement piece is therefore the reason we're trying to work this out is because if I have a shortfall, if I haven't reduced my emissions by this point, there potentially is a need to purchase offsets. And that's where I guess the financial part comes in. And I guess that's where that sort of trigger and actually understanding when do I reach that. And one of the challenges put to me recently was, you know, we have accruals accounting. So if I know I'm going to be building up to this, you know, the IFRIC decision has the past event at the point where I make an emission that is sort of beyond what I said I was going to do. And therefore almost everything after that potentially would be offset. Whereas obviously on an accruals basis, accountants' mindset says, well, I should be, if I'm always short a few, you know, 10% emissions each year, should I be doing something on an ongoing basis? So I think that it really poses quite a lot of interesting technical accounting challenges around what we, you know, our general principles around how things occur versus actually where the standards are. And I know probably Alison will talk to it a bit later, but I think, you know, part of it comes back to, and I think your point earlier, what goes in the financial statements and what can be accounted for is determined by the accounting standards. But there is still an obligation on a company to actually think about what information their users need to know about their commitments that may not meet all the criteria of the accounting standards. And therefore, what are those obligations actually around how do I communicate transparently my commitment and what that means in other areas of my reporting. And I think that's something that we mustn't sort of forget in this. We can get very caught up in, does it tick the box or doesn't it? But actually, and as I said, I think Alison will probably point to that a bit later as well, around that sort of actually what do users expect to see, and how they get that information. It's less about whether it's in the financial statements or in another form. So I probably posed a lot of the challenges. I don't think I have all the answers, but hopefully that was useful.
That's very useful. I'll come to Alison for that question later, but I also hear Patrick's perspective from the CPA Australia members.
Thanks, Eric. And I think one of the big things we're struggling with at the minute in terms of member expectation is getting it across that a net zero statement is not a net zero transition pathway. Those are two very different things. So you can make a statement, but the point I think I always make is without a transition pathway that backs that, it's actually meaningless. Because you need to evidence to the market how you're going to get there. The problem with that is, to Karen's point about, you know, carbon measurement, once you have your carbon inventory and that sets the baseline in terms of how you need to get to a net zero position, that's a very interesting space, because then we start talking about forward-looking information into the future, which is always fraught with danger because it can move quite dramatically as the science evolves. So that's an issue, in as much as, you know, the veracity that's built into those kind of statements of saying, oh, we'll be net zero by 2030 or 2050. And I think we need to decouple the ambition that's built into it with the reality that you may overshoot or get there quicker. If you get there quicker, well done. But it is an issue in terms of how that needs to be adjusted on an annual basis. So I think initially what we'll probably see in the market is transition pathways being reported, but then on an annual basis, you'll need to go back into that particular pathway and look in terms of your initial recognition, and then look in terms of subsequent measurements in terms of how it's moved up or down, and whether that provides that pathway to get to that particular target point that you have in the future. So those are kind of things that I think will be quite dynamic in the market, and I don't think there's an established best practice at the minute in terms of what potentially could look like. So, you know, if you listen to the kind of things coming out of ASIC, in as much as you know, they're not even talking about enforcement strategy at this point in time, because they recognize that there's this upskilling that needs to happen in a step-up fashion. But it is a game of maturity in as much as how organizations will actually move to that. The second point on that is just, I think that I use this in its loosest possible sense, but the disconnect in between sustainability reporting and financial reporting, because I think at this moment, organizations are still struggling to get their sustainability reporting or climate-related reporting in the first instance proper or done properly. And then you have this second consideration in terms of, okay, fine, I've got this piece done. The second component to that is then how do I translate what I've said in my sustainability or climate-related report and quantify that in terms of impacts on, you know, your balance sheet or the rest of your financial reporting. And I think, again, that is going to be a question of time, in as much as the maturity kicks in terms of the sustainability reporting, and how the quantification of that particular kind of statements and impacts that you identify matures. I think then it'll be, look, I use, again, quantifying impacts for financial statements is never easy, but it will become easier over duration and time as you get a grip on, you know, the kind of information that you're disclosing in your sustainability report. So, yeah, look, I think it is an evolving space, and I think there's no expectation on organizations to get it right from day one. there is that expectation that over duration and time we'll all grow with this. My biggest concern is actually not the bigger end of town, but potentially what that's going to look like one level down for SMEs, because there is no gold standard for SMEs, nor is there, a clear articulated expectation of what scope 1 and 2, reporting for them would look like potentially. If you want to go down the scope 3 avenue, which we know, according to the legislation, you'll have to. So again, I may have added even more concerns than Karen's raised without giving any answers. But it is a very complex kind of space, and I think my baseline point is just it's a game of maturity, and we just have to write this out, get started, but recognizing you're probably not going to get it 100% right, at your first attempt.
Totally agree with that, Patrick. And I like your statements by saying that we can't get anything right in the first time, right? So we're still learning. And this is when I want to ask Alison, who is a user of financial statements. I'm keen to hear from your experience. What have you seen and what have you not seen entities disclosing information that you think is important for your decision making?
Sure. Thanks, Eric. And I have been researching corporate climate risks and their responses to it for investment decision making for 20 years or so. And so, we're saying a lot about how this is new and we're learning. It's actually been around for a long time and there's been a lot of activity, but it's still quite difficult to find the information we need. Sometimes that's actually because there's too much information rather than too little these days for the large end of town, I would say, which is the case for most investors. They're looking at the largest corporates. But what is out there, it doesn't currently come from the financial accounts. Typically, it would be in sustainability disclosures, in standalone reports, and even data books to supplement that. Sometimes there's a dedicated climate report, especially for companies that want to put that to a say on climate vote. And so then information can even be in proxy papers or pre-AGM investor briefings, those sorts of things. And we do also see investor roundtables and even whole investor days and site visits focused specifically on climate plans. So where we find information is not at all standardised, and it's not standardised in terms of how it's presented. So it does make quite a lot of work. At Australian Ethical, we're really highly motivated to find this information. It's central to our investment approach, but I think that others will be put off trying to find it or trying to wade through it if there's a lot there, and potentially just discount how well the company is addressing climate change if it's too hard to work out that answer, or rely on a third-party perspective which summarises it for them.
Now that's helpful to know from that perspective, from users' perspective, on how information should be connected and related to each other in disclosures. But I also have a question. When we were discussing about some entities disclose that they claim to commit to climate change related commitments, but at the same time, you may not have enough information on it. So is there a way for us to differentiate whether statements is actually greenwashing statements or they are actually credible information? And perhaps also give some examples, practical examples for preparers to consider, making sure that they're not giving false impression to users as well. Any views on that?
Yeah, absolutely. It's a really high stakes question for us because our investment decision will actually turn on the information. But it's also high stakes because we're making commitments to our stakeholders, and making the wrong call on whether our investments are serious about their climate commitments can affect our reputation as an ESG investor, as a responsible investor. And I mentioned that investors get information from a lot of places, not just the financial accounts, and I've talked about some of those things already. We do look at third-party perspectives, NGOs in particular, as a credibility test on what corporates do. How are they being evaluated by others? What are they leaving out of their disclosures that other people are putting into the market? A key further source that investors have access to is direct discussions with company leaders and company directors. And there's a qualitative element to that. You know, it's not just the information that they share. I want to get a strong sense from those conversations that the business really understands what climate transition means for their business and that they've got a considered approach. I think Patrick talked about before maybe a gap between when a company makes a commitment and when it has a plan. I think a commitment without a plan is not something that we would treat seriously, right? It's an intention to work it out. It's not something that we can invest on the back of. So we look at all of those kind of sources. We also look beyond what the company discloses to what they say in the media, what their CEO says at presentations, but especially their climate policy engagement, including through their key industry groups. So if we see action that's lobbying to delay and water down climate action, then we're going to conclude that that company is not serious about climate transition. In fact, what we're really looking for these days is for companies to be quite vocal in support of climate ambition. And I think we'll see a lot of investor scrutiny around how companies are feeding into Australia's next international climate target. It's that next NDC that needs to be submitted next year. Are companies being silent? Are they speaking up, or are they arguing for a weak target? Will be a consideration on their overall credibility.
Thanks, Alison. Okay, so I'm going to ask a question that was being posted by an audience. I wonder how we turn this into dollar amounts. Presumably an obligation represents a liability that is amortized as the obligation is met over time. For example, the obligation to convert 160 hectares of paddock to 250 hectares of forest. What is the amount implication spent to restore perhaps a measure of a physical objective, such as a measure of biodiversity? So a costing issue, and then we need to account for net present value and revaluing, of course. I'm going to throw that question to Sue. Sue, would you be able to provide some insights about that question?
Thanks, Pat. Thanks, Eric. And thank you very much for the question. I think this is a really, really important thing to get at. And what I see in my interactions in this field is that there is a little bit of confusion between what I'm going to call real dollars and what I'm going to call kind of social dollars. So, for example, we know that the social value of carbon is very, very high. I can't remember what the United States are currently estimating it is, but you know, it might be $100. Whereas what you actually have to pay to get an Australian carbon credit unit at the moment is around about $25. Don't quote me on those amounts. But the social value of carbon is much higher than what you actually have to pay for your act use. So there's the real dollars and the social dollars. In the same way as there is the real dollars that you will pay to go to a doctor for advice on your health, and then there's the amount you value your life, you know, very different amounts. So in this little case of biodiversity, when we talk about converting pasture to grassy woodlands, the work that's associated with that is you know, planting trees, weeding, putting native grasses down, more weeding, you know, more weeding over time. And so those are the activities that would be needed to cost. They're relatively tractable to estimate. And they're very, very different numbers and much smaller numbers than the biodiversity value of that piece of land now in terms of its social cost. So the points I would make is when we're thinking about doing these monetary valuations, let's be very, very clear on what we're actually talking about quantifying here. What are the concepts we're quantifying? So that's how I would answer that question in a room full of accountants.
Thanks, Sue. Okay, next question. I'll be interested in thoughts on whether and how the scenario analysis required flows into the quantification of financial impacts, given the scenarios are hypothetical and even when quantified are based on very shaky numbers. Example, carbon price projections. Patrick, I've seen you have slightly responded to that, but would you like to elaborate your response as well?
Yeah, This is always the issue in terms of, climate-related considerations, in as much as where does everything fit? I have yet to see a diagram that summarizes everything succinctly, in as much as where all the components actually fit, which could make it easier for members to understand. But the point I'll make about scenario analysis is that in order for you to do that risk assessment exercise as an organization, and we're not talking about materiality here, we're just talking in terms of, if you've already identified nature as being, or nature or climate as being material, how do you then anticipate what the potential impact would be? And that's where scenario analysis actually comes in as much as setting, and it's not a prediction, it's not an exact exercise, it's basically saying, and this comes back to the, the question about the shakiness of information, but it does give you a probable kind of indication of what the future potentially might look like. And on the back of that, that would then lead to conversations about, potentially if situation A arises, what potentially will be the impacts of physical risks and transition risks on the organization. Ultimately, the choice in terms of what kind of model is being utilized is also embedded in terms of the risk appetite of your organization, and will be viewed from that particular perspective. But the point is that the risk assessment piece and the quantification piece is actually, the scenario analysis sets the potential for the future in terms of what the but what the risks could look like at that particular point in time. But the quantification is actually a different kind of exercise. And in the response I actually posted, there's two components to that you can think of. So, from a physical risk perspective, the quantification piece comes in terms of, if you know that you've got a warehouse that's in an area with increased flooding risks, we then need to start thinking about asset impairment, and how do you actually flood that through, your financial statements. Pardon the pun, I just realized that. And then secondly, if you think about how your business model needs to, I hate this word, pivot into this new lower carbon state, that'll have implications on things like CapEx, in terms of how do you get your processes to be lower carbon, or how do you think about revenue streams in the future? And that will have a potential impact in terms of your profit and loss statement. So it's these kind of things that will be the next steps. Scenario analysis sets the landscape or the backdrop, and then the risk assessment piece and sort of the extrapolation of what that looks like in terms of strategy and business models, that's the next couple of steps into the future. But I appreciate that it's not an exact science. I appreciate that it will give you sort of an indication, but this is not a crystal ball that will give you, sort of the universal number is 43 or whatever. It absolutely does not aim to do that at all.
Okay, thanks, Patrick. Lachlan, do you have any views on this?
Yes, so from a physical scenario analysis, I'll just share my screen again. The sort of a large approach, a lot of the banks, supermarkets and other companies we're speaking to are trying to model out the future analysis. So what we've done, for example, is to look at what's the current risks. So we're mapping out all the previous bushfires or the floods in the future, for example, currently and in the past, and then we overlaying all the characteristics that have caused the fires to occur. So what's the changes in temperature or in biomass, in wind speed, and then we use the CSIRO BOM, who jointly have created the future scenario cases. So it goes out to 2090, different intervals. So then when you can input in the model future temperatures or future rainfall events for future months, even though it's not an exact science, it's sort of the best analysis that we have, and you can sort of benchmark that across a portfolio of loans or farms or all your customers.
Okay. Thanks, Lachlan. So another question from our audience, really interested in an investor or science view on the example scenario presented today in terms of reputation and being genuine. Surely the supplier should be dropped rather than relying on very uncertain assumptions, that is, biodiversity into the future is basically unknown. None of this seems to pass a pub test of actually caring about biodiversity. Shouldn't you go to another supplier who is not going to ruin a woodland? Perhaps I'll first get Alison to provide some insights, and then I'll also get Sue to provide some insights on this question.
Sure. So happy to comment on this, both climate specific and nature. So I think investors generally, there is a very active conversation about offsets. Investors are very concerned that that's not, you can't just offset your way to net zero. The world can't offset your way to net zero. We need real world change, real world reduction in emissions. We're talking about a transformation of energy and economic systems to a more sustainable footing. There's not enough offsets available in the world to solve this problem. And so typically investors are looking for offsets to be a last resort. You know, when you've done everything else you can, there's something that the technology doesn't exist for a period of time, you'll offset to get to the Paris-aligned pathway, for example, if that's what you're trying to achieve. So it's absolutely part of the evaluation and part of the conversation on climate. On biodiversity and nature, the investor conversation is really just getting going. So we've been looking at climate for 20 years plus. Nature, I feel, is very nascent. So the thinking around the role of offsets, biodiversity projects is still evolving. That said, Australian Ethical, what we look for impacted sectors is a commitment to zero deforestation, which is very different to the no net deforestation commitment in the example presented earlier. And you know, I was thinking about this ahead of the webinar. How would something like a zero deforestation commitment find its way into the accounts? I don't think that kind of information is going to live in the accounts. I think it's going to sit still in policy statements or some other document that still gives us a high conviction that that's a real commitment, and then we see that followed through in terms of action.
Thanks, Alison. Sue?
And I agree with everything Alison has said, and I'm smiling to see the really astute observer actually picking up that little piece in our scenario. So the scenario is, of course, that Clothing by You has been purchasing wool from Woolly Jumbuck, and then Woolly Jumbuck has cleared grassy woodlands. So, so the first thing that happened was Clothing by You did not actually say, as part of their contract to purchase wool from Woolly Jumbuck, that they required Woolly Jumbuck to also sign up to a no net loss of biodiversity. So the first point is that Clothing by You did not establish that as part of their supply contract with that entity. So, so what I would expect if I was in charge of Clothing by You, I would immediately look for another supplier. So going away, you know, because probably Woolly Jumbuck shouldn't have done that even without a contract, but that's a value judgment. So I would expect Clothing by You to actually look for another supplier, and then to have learned from its mistake and actually include that backup commitment in that contract. However, that action of switching suppliers does not satisfy the obligation to restore the lost biodiversity. So the restoration of the lost biodiversity still has to happen. And so that's why the contract with Echidnas Incorporated to actually do that restoration makes sense. Now, of course, Clothing by You could have asked Woolly Jumbuck to restore the biodiversity, and that would have been a very interesting conversation to be a fly on the wall to in reality. But I'm really pleased that observation about that part of the scenario was made.
Thanks, Sue. Okay, so there's a lot to think about. So we're now going to move on to technology piece. So obviously, Lachlan talked about how AI and technology can help with measurements. But the other way of, if we think about technology, we can also think about how technology can help entities on reporting, because there's so much information entities we need to think about and report. So I'm now going to ask Karen a question about the importance of digital reporting. You know, we have been talking a lot about digital financial reporting, but then we're now also coming into the space of digital sustainability reporting. Do you have any thoughts or views on this, Karen?
Look, I mean, when the government were bringing in their mandatory climate disclosures and starting their initial consultation, they did actually ask some questions around digital reporting. I think, you know, it would be, in an ideal world, we would be saying, look, the sustainability reporting, the climate first approach that Australia's taking, it will be digital first as well. That would be where we would want to be. And I think that's where other jurisdictions around the world probably are. Unfortunately, Australia is one of those, and New Zealand similarly, they're one of the few jurisdictions who do not have digital reporting for the financial reporting. And therefore, do we think it's realistic that we're going to see digital first for sustainability when we haven't got it for financial? No. Can you do the digital financial? Yes. Is anyone doing it? No. Because it's one of those things that the benefits for it for both the preparers and the users only happen when everybody does it. So it's not something that's just going to, I guess, sort of organically grow over time. It's an extra cost for the preparer to do it. They're only going to do it if the benefits are there for the users, and the benefits for the users are only there if everyone's doing it, because that's how they get the data analysis going. So we're in a little bit of a catch-22 situation, and really it's up to government to actually make that step, and think about actually at what point are we going to say that it will need to happen, and where do we go from there. The good news is the sort of architecture, the taxonomies as they're called, in terms of actually what needs to be reporting for both the financial and now the sustainability, are all there and ready to go. So it's something that can be enabled. From a global perspective, it's all ready to go. I think it's just a sort of a piece at the moment, as I said, where we're just in this situation. A lot of other jurisdictions and the major capital markets do use digital reporting, so there's a huge opportunity for Australia here.
Yeah, I can't agree more, Karen. I think there's a lack of education on not even about preparing, but using digital reporting information. And AASB had just recently released some publications about digital reporting. So I encourage everyone to look at that education piece if you're interested to find out more about digital reporting. And so, Lachlan, you gave us some insights about how technology these days can measure better about greenhouse gas emission and so on. I mean, we know that the technology would be improved rapidly, just like any technology tools that we have in the market. What would you like to see in technology space for better measurement and better used by preparers or users?
Yeah, it's a great question. I think there's because it's still quite a new area, there's a lot of different approaches to work out your emissions and your and climate risk scenarios. So it would be good if there's a sort of a more of a standardized approach. We're trying to focus as much as possible on the scientific angle. And then from like a digital angle, we're trying to get monthly updates, for example, across, so it's an API call of, you just provide a list of suppliers, we'll provide the emissions of the suppliers, and that is the sort of approach we're taking. And we're trying to partner with federal government, so then it's a much more of a standardized approach. You can't really disagree with it as much. So I think more of a standardized approach, I guess more transparency in it, because there's a few different range of methods. And even in, say, what's called emissions calculators, you've got a whole range of different approaches, and they're constantly updated. So it's sort of good to know what people are actually using.
No, that's helpful, and also I think technology can also help with assurance as well, and we know that it's also another challenge in this space. There's another question from audience. I'm new to the field, so apologies if this is a silly question. No, there's no silly question for us. Just wanted to ask for clarification. When you speak about obligation, is it an obligation to disclose a loss of biodiversity or an obligation to restore the biodiversity, or both, if an entity makes public commitment of that nature? I'm going to throw that question to Karen. Karen, would you be able to share your insights about this question?
I'm not sure if I will be the best person, but I'm not sure, Claire, whether you have any thoughts on this. I think it might be more in your space, if I don't mind handballing that one across.
That's fine. Thanks, Karen. I'm happy to tackle that one. So, and Sue, feel free to jump in also at any point. But no, I think it is both. Like they have made an obligation that it's that they are not going to have any loss. So they need to recognise the obligation to recover that loss so that they are back to zero, basically. And so in a sense it is both, because there is the initial loss, but then you need to work out, okay, how much is it going to cost to then recover that loss? And that's and so it is the cost that is then recognised as the liability.
Thanks, Claire. Whenever I see this kind of question, I like to use the vice president of the AASB's wording. That is, things about this can be complex and depending on facts and circumstances. So the best way to think about this is really depending on the facts and circumstances on whether a provision or liabilities should be recognised. Okay, so with that, I think we have covered a lot today. Lots of good questions, a lot of good insights from all the presenters and panelists. So I think I'm ready to close the session. Before I close the session, though, I would like to share with you that the AASB has a research project on cash flow statements. Now, this is an important topic. For example, a common question that we get sometimes is, should entities disclose the information about cash that being set aside for climate-related commitments? All right, because that's something perhaps users would like to know. And so if you have any thoughts about how the cash flow statements can be improved and provide users better information, please reach out to us as the AASB staff. We'll be willingly to spend time and speak to you. So to close the session, I'd like to thank Sue and Claire in particular for suggesting this topic for the session. And I think it's just timely and relevant for everyone. I'd also like to thank Lachlan, Alison, Karen, and Patrick for your valuable insights. And thank you for CPA Australia and CANZ for having this joint session together. So again, thank you again for everyone's participation. The next session will be in early July, and it will be about practical challenges of valuation in financial reporting. I hope we'll see you again, and enjoy the rest of the day and have a good weekend. Thank you, everyone.